good quality companies, the Coles of this world, the Oricas, the Horizons, the Cleanaway, the Metcash. I mean, those companies are not going to go away. The funny thing is, even though the market's quite high and hot in some sectors, there's actually quite good value in some of those. We're still finding quite good value. At some point, if the economy does pick up, then potentially there could be inflation later on down the track because there's been so much money pumped into the system. If you look at the buy now, pay later, if you look at things like Tesla in the US, it's pretty hard, I think, to justify the prices today. Try not to worry too much about the overall market. I mean, the market will have its gyrations, it will go up and down. And the truth is, term deposits, you can't really have your money in cash anymore because you earn zero.
Anton, welcome to the show. Really great to have such an experienced market operator here. I'd love to know, as a start, help us make sense of things. How bad is this crisis compared to everything you've been through? And you've been through a lot. Global financial crisis, Asian financial crisis, the European debt crisis. How bad is this on a scale of 1 to 10?
Well, this one's a very unusual crisis, put it that way, because this is the first crisis that I've lived through, and in fact many people have lived through, that's actually been caused by the actions of government because of a health issue. So it's very unusual. If you look at previous crises, there's been normally an excess and interest rates are put up, or there's a bubble forms and central banks tighten up rates or whatever, and that normally causes some sort of financial crisis, which occasionally turns into an economic crisis. This is very different. This has been actually caused, as I said, by the actions of government. Now, obviously, they didn't purposely want to put the economy into recession, but obviously their actions in terms of trying to contain the pandemic have obviously led to, a recession of sorts. And again, I think it's worth pointing out that it's a recession of sorts, because it's quite a very different recession. Because again, what's happening in this recession, and I put inverted commas, because some sectors, the airline industry, hotels, etc., they're down sort of 90, 100%, and then other sectors like some retail, Bunnings and whatever, they're actually up. So net, it's a recession, but it's a very uneven recession, because as I said, some sectors have just been absolutely smashed because of the restrictions, and some sectors are actually benefiting because because the government has pumped so much money into the system, and B, because people are using the money, for example, instead of travelling, they're going out and buying a new sofa from Nick Scali or whatever.
And so is that the thing that surprised you the most? This is a controlled economy we're in.
Well, as I said, we've had these the actions of government that have put us into this situation, in a sense. And I think government feels responsible now for sort of trying to drag us out of it.
Sure.
As I said, on the one hand, the government's put all these restrictions in place. On the other hand, the government's spending like there's no tomorrow to try and get us back to sort of GDP growth.
Okay. I'll come back to if that's causing any pent-up demand, but let's talk about markets next. So we're in a two-speed world right now. Australia and New Zealand doing relatively great. We're easing restrictions. We're even talking about flying into each other's countries and travel bubbles between different states. In the US and Europe, things are going the other way. Cases.
Well, that's not quite right, actually. In Europe, people are flying around. International airports are open, and people are flying around. UK, Britain, France.
But is there the confidence there just because of how much cases are increasing?
They're flying around. And actually, it's interesting, again, if you look at Europe, the case numbers are up greatly, but the number of deaths is way below. So the case numbers are way above where they were in March, but the deaths are well below where they were in March. And that's because what's happened in Europe, people have been told if you're old, if you're vulnerable, stay home. If you're young, be a bit careful, but you can go out, you can go back to the office. So again, I think that's the other thing about this whole situation, is how every government has handled it differently. And I mean, in the US, every state has handled it differently, And in Australia, again, we've had Queensland shutting the border with 2 cases, and New South Wales, thankfully, keeping things open even when cases spike to 10 or 15 cases. So yeah, it's been very, inconsistent actions of government and very difficult to predict.
Okay, it's very fair things you pointed out, but when we put that all together, does that make you bullish or bearish on markets?
That makes me, I think, like everybody else, very confused, because I think the truth is, as I said, what's happened is some sectors are doing well, some sectors are not doing well. On the other hand, you've got this deluge of money that's been, pumped into the system either by central banks or by governments with their fiscal largesse, if you like. On the other hand, the central banks are keeping rates as low as possible. So, I mean, as I said, it's quite an unusual period because, in a sense, it's an economic boom in some sectors, but a depression in other sectors like travel and hotels. So it's a confusing time. So again, we saw with the budget yesterday. Again, a huge budget deficit, all these handouts. Now, at some point, if the economy does pick up, then potentially there could be inflation later on down the track because there's been so much money pumped into the system. But as I said, it's very unpredictable. And again, if you look at the housing market, it's been very strong. Now again, in most recessions, when unemployment goes up and there's uncertainty amongst investors, house prices normally get the wobbles. In this case, we've seen house prices actually quite strong. So as I said, it's a very unusual period because as I said, you have a recession caused by governments through their lockdowns, which are now being eased, so that's sort of getting better. But on the other hand, they are putting all this other stuff in place, whether it's very low interest rates or huge handouts to stimulate the economy.
Okay. From a business investment perspective, something that you said that I found really interesting was that ASX companies are planning for a soft 2021. What does that mean? And I'd really like to know, what does that mean in terms of employment?
Yeah, so what that means is obviously many companies are trying to forecast, the next year or two, and I guess many of them are as confused as everybody else, quite frankly. And if you're a business leader at the moment looking into 2021, new projects, capital expenditure, would you be, so there's a bit of a hesitancy from a lot of companies because of that uncertainty into 2021. And in fact, a lot of companies are looking perhaps to reduce staff numbers, and they're holding, and that capex, that capital expenditure that they may have gone for in 2021, they're perhaps deferring to wait and see how it eventuates. So, that's normally not very positive for the economy. But as I said, on the other hand, you have the government who is, doing lots of things to stimulate the economy.
Is there also a cost out story within that though? Like if you're planning for a soft 2021, if you recalibrated your business to be more online, if you will, does that mean these businesses will have more operating leverage when demand does bounce back?
100%. And in fact, there are a couple of cases. I could talk about Sky City in Auckland, which has, reduced its staff numbers during the lockdown in Auckland. Now the casino is open and, the business is doing very well because they're obviously New Zealanders can't go anywhere. Those who like to gamble, they're gambling at Sky City in Auckland, and Sky City in Auckland obviously have kept their costs quite low. So there is that leverage, yes. Okay. And at some stage, if that continues, companies will have to start employing people again.
Okay, so let's turn to a different theme, which is around technology. And you wrote a wire on Livewire, a really interesting one called A Tale of Two Stocks and what it tells us about the market. And you compared what happened when Metcash
money and Metcash.
And Metcash, yes, that's right. Two completely polar opposite reactions from the market. What is that telling us about markets?
So, well, one of the consequences of low interest rates is it's also causing, I think, potentially asset bubbles in the stock market. Yep. So obviously, low interest rates are good in terms of stimulating the economy, in terms of people having to take more risk, rather than have their money sitting in cash or term deposits. But I think what it's leading to is some sort of irrational exuberance in some sectors. So if you look at the buy now, pay later, if you look at things like Tesla in the US, it's pretty hard, I think, to justify the prices today. Now, again, the issue with those stocks is they tend to be long-dated stocks. So, I mean, Tesla, what's Tesla worth? I have no idea. Nobody knows how many cars Tesla
changes wildly every day.
Well, no, but that's the share price. But in terms of trying to do a forecast, I mean, how many cars will Tesla sell in 2030? How many cars will Tesla sell in 2040? You could say 5 million, 1 million, 10 million. We'll probably all be wrong. But the point is, if you put in optimistic forecasts for a stock like Tesla and then you discount it back using current interest rates, you can end up with it whatever value you like. So, low interest rates also has an impact, in terms of the amount of money that's looking for all this hot money, but also in terms of how you value stocks, it also has an impact on that.
Okay, so against that, what are you avoiding in the market? What are you just not wanting to invest in? Technology sounds like it's one of them.
Well, technology, again, nothing wrong with technology stocks. Again, as I said, if you look at the US, which has got, global giants, Facebook and Google and Apple, etc., all very profitable, all global, all cash on balance sheet. Very different to, what we have available in Australia. So, there's technology and there's technology, I think, number one. So look, in Australia, we are, as I said, fairly limited in terms of good quality technology companies. But what we do have is very well managed companies in Australia, good industrial companies. Some of them are global, some of them specialise locally. So you mentioned Metcash before, which has been doing very well through the pandemic. It's spent a lot of money in the last few years upgrading its stores, upgrading its systems, bringing its prices to be more competitive with Woolworths, Coles and Aldi. And what's happened through the pandemic is the shop local, people have been going to their local IGA and they're actually saying, well, actually prices aren't that bad. And they've actually fixed up the shop. So as things reopening, what's happening is they've found their market share is actually a bit better than it was before the lockdown. So there's a company that's actually benefited in a sense from it. So a company like Metcash we like. Then you've got these global stocks, which happen to be based in Australia. I mean, Amcor is one, which is a global leader in flexible and rigid packaging. Orica is another global leader, happens to be listed in Australia, largest explosives company in the world, with operations in North America, South America, Europe, Asia, Africa. So, those sort of companies, they haven't really taken off. People are very cautious on them, it seems. As I said, they're very well managed companies. They've got very good balance sheets, very good track record of producing good cash flow and dividends, and those are the sort of things we quite like.
Okay, we'll focus on industrial stocks in a bit. I just want to come back to what you just said. There's technology and then there's technology. Mm-hmm. Do you believe that there's actually some inherent superiority with the US tech companies, the FANGs, versus what we've got in Australia?
Well, in terms of the scale that they've reached and in terms of yes, I think there is. And I think what's happened, and again, that's not saying that perhaps one or two of the companies in Australia may be successfully globally, it's too early to tell. But again, as I said, those companies in America are global leaders now. They've got cash on balance sheet. They make lots of money. The ones we have in Australia, so they're more like startup type companies. So while Afterpay is growing, it's still yet to make a profit. While Zip Money is growing, and again, they're not really technology companies. They're more like credit providers actually that happen to use an app to provide the credit. So again, there's not that much technology involved in what they do. They're just giving people interest-free credit. But those companies, as I said, Zip Money, Zip One, and Afterpay, they don't make any money yet. So again, very difficult. When you look at Facebook and Apple and the amount of money that they make, their balance sheets. We read many of the companies in Australia are at a different stage, and not all of them will succeed. In fact, the vast majority of them probably won't.
Okay, and is that the risk? Is that the risk for investors, that if you're investing in an early stage, you're taking a higher risk versus investing in a very well-established, a Google or Facebook?
100%.
Okay.
That is the risk, yes.
Okay. Are there any technologies?
There's excitement and there's a lot of upside, potentially, if they get it right, although, again, one would argue that a lot of that upside's captured now. Afterpay is capped at $20 billion, which is quite a lot of money for a company yet to make a profit, so...
Is there any technology company you rate or own in Australia?
No.
None?
No.
Okay. All right, let's move on to what you do like in this environment. What is quality in this environment against everything that's happening? And especially, how do you identify quality when there's a mishmash of situations? You've got forced closures of different sectors or restrictions, and then you've got stimulus payments. What's quality in this environment?
Yeah, look, I think we've always defined quality as companies with a strong competitive advantage, so they're number one or two in their industry, and they've got a moat around their business. It's very difficult for new entrants to come in. We like companies with recurring predictable earnings. We like companies that are run by experienced, management who've got a track record of doing things right, and companies that can grow over time and trading at a reasonable value. So, look, as I said, there are the funny thing is, even though the market's quite high and hot in some sectors, there's actually quite good value in some of those. We're still finding quite good value. So, Horizon, for example, it's not everyone's cup of tea because they move coal. They own the Queensland Rail system, and one of their biggest customers is the coal companies in Queensland. So some people say, coal, they don't want to touch it. But anyway, that be it as it is. Horizon didn't make that choice. It just happens that its rail lines are in Queensland, and Queensland's a big exporter of coal. So that company, good balance sheet, pays a good dividend, very well managed company, unique assets, looks very good value.
So you've given me some stock ideas, but what's your underlying process in this environment? What exactly are you looking for? Give me the detail in terms of, does it have to have a certain return on equity? Does it have to have certain operating leverage? What are the key things you're looking for?
Well, as I said, we look for companies that are number one or two in their sector, in their industry. That's what we like. And then we look at, do they have a competitive moat? What is their competitive advantage? Because that to us is very important. Because when tough times do come, and they could still come, no one knows, as I said, but when they do come, companies that have got that scale and that can operate despite tougher conditions tend to do a lot better than companies in a commodity type business. Okay? So look, we quite like the casino stocks. So Sky City I mentioned in Auckland, which is now Auckland and Adelaide. That's reopened. Crown is one that's a bit on the nose at the moment for various reasons. Partly because the casino in Victoria is closed at the moment, obviously, and partly because of the commission going on at the moment in New South Wales. The inquiry that's going on as to whether Crown should hold the license in New South Wales. So those things are weighing on the stock quite dramatically. But again, if you look at Crown, the properties they own, they own their Burswood property, they own Crown Melbourne, they own Barangaroo.
Yeah.
The licenses, Melbourne is till 2050, Burswood is till 2066. Barangaroo hasn't started yet, but it'll be till 2112 or whatever. Long dated licenses, unique assets, unique licenses. We think Crown at the moment, on a 3 to 5 year view, looks pretty good.
Okay, so number 1, 2 in their industry, wide moats, long dated assets, good dividends.
And not overvalued.
And not overvalued. Okay, so you've given me bonanza of stock ideas, thank you. Let's move on to REITs. In your book, 20 Lessons from 20 Years of Quality and Value Investing, you said that REITs can add income and stability, and that certainly seemed to be the case, but then COVID happened, work from home happened, e-commerce boomed. What do you make of this sector now?
Yeah, look, it's a difficult one. It's a difficult one. So look, we've stuck to REITs through this the last 6 to 12 months. Really, we've stuck to REITs which have had Coles or Woolworths as a anchor tenant. So things like Shopping Centres Australia, Charter Hall Retail. Those are the things we're doing. Bunnings Warehouse is one we bought. We bought when they fell in March because Wesfarmers is the tenant and they got long leases. Look, it's a bit more when you come to office trusts now, etc. It's confusing because obviously, more people are working from home. There will be some pressure on office rents because of perhaps lower demand. Because possibly unemployment will be higher, and also possibly because people won't want to return in a hurry back to offices, right? So it is a difficult one. Similarly with retail shopping trusts like Centre Group and Vicinity, which have got, people like David Jones and Myer, which we've sold out of, who are struggling, and a lot of the smaller retailers are struggling a bit. So look, those are, they're in a pretty grey area. At the moment, we're not really investing in those office trusts and those pure discretionary REITs, and we're sticking to the more defensive ones, which have got an anchor tenant, have got a supermarket as an anchor tenant.
Can you quantify what you've done? So how much was it in your portfolio? How much is it now?
Oh, look, for example, Charter Hall Retail, we probably didn't have any 6 months ago or whatever, and now we've got 1.5% to 2%. Shopping Centres Australia we've always liked. Bunnings Warehouse, We bought some as they dropped, maybe 1 or 2%. It unfortunately didn't stay down long enough. But yeah, and the rest, as I said, we've avoided the vicinity groups, etc. At this stage because the outlook looks pretty tough.
Okay. So you talked about you sold out of Myer. That's what I wanted to touch on. You bought Myer, I think it was 2 years ago, and the thesis was...
A few years ago.
The thesis was this is going to be a turnaround story. The share price is a lot lower today, and you've sold out. What happened, and what was the lesson?
The lesson was, I think the company looked like it was turning around. Actually, it didn't. It slowed down. I think we were encouraged and looked forward to Myer moving, they're online a lot quicker, which is what they were planning to do. And I think the investment thesis with Myer, apart from the fact that they want to reduce the floor space, which they need to do, was also, they've got their hidden asset, if you like, is their Myer 1 database of 5 million. They've got 5 million people on their Myer 1 database, of which about 2.5 to 3 million are active, constantly active. And the thesis was, if they could combine that database with an online shopping offer and integrate it, then that could have done very well. And in fact, you could imagine through the pandemic how well that's done. But it's just taken Myer.
But so they didn't execute?
They haven't. It's still sort of work in progress. Many years later, when they kept saying the online is at the front of the queue and they want to refine it, etc., and it hasn't happened yet.
So going
as well as it should have.
Sure. So going forward, Anton, when you look at a retailer, what would change about the way you look at a retailer based on what's happened to Myer?
I think discretionary retailers are always hard to invest in, to be honest, and even the JB Hi-Fis and the Nick Scali's and the Harvey Normans, because they are very cyclical, So we tend to try and stay away unless there's a clear turnaround or something, or there's a rollout happening or whatever. So the retailers we like to stick with, as I said, are the more the ones with the more resilient recurring earnings. So things like Metcash, Coles is one as well. We've bought a lot of in the last 6 months as the stock price fell to sort of $15 and below, and there's Wesfarmers sold out. We think Coles looks very good for the next 2 to 3 years, not just because obviously supermarkets sales are doing well because people are eating more from home, but also Coles are shutting down, their distribution centre network is very antiquated, and there's huge potential cost savings from making that more efficient.
Okay. My favourite question now, Anton. You've got a lot of experience in markets, and investors today are clearly very, very worried about their wealth. If they look at what's happening in markets and the daily, just the daily noise, it can get very, very tiring. What would be your words of wisdom to investors who are, they don't know if the market's going to fall again and have its second wave?
Look, I'd say try not to worry too much about the overall market. I mean, the market will have its gyrations, it will go up and down. And the truth is, term deposits, you can't really have your money in cash anymore because you earn zero. And you have to look to buy assets now to try and earn an income. If you've saved money to live off the income from that money, you can't do it having it in cash. So you have to look at alternative sources. So obviously one's got to be careful because you are taking more risk. But as I said, if you look at the stock market, good quality companies, the Coles of this world, the Oricas, the Horizons, the Cleanaway, the Metcash, those companies are not going to go away. They're all number 1 or 2 or whatever in their industry, or 1, 2 or 3 in their industry. They're all, they've been around a long time. They make very good cash flows. They pay very good dividends, and you have to look at those sort of companies. Amcor's another one, on times of weakness, because the truth is, rates are low. They're probably going to stay low for a while because until the economy recovers, the market will be volatile. But as long as you're not chasing, the hot sectors and the hot stocks and sticking to good quality companies, I don't think it's a bad time to invest necessarily, because rates are so low that it makes the yields and cash flows from those companies look pretty attractive.
Fantastic. Anton, learnt a lot from our conversation today. Thank you so much for your time.
Pleasure. Thanks for your time.